Every trader who's ever made money consistently has a graveyard of blown accounts behind them. That's not pessimism. That's just how this works. The market doesn't hand you competence. It takes it from you, piece by piece, until you're forced to adapt or quit. I've been trading since 2020, 6 years in, across Forex, gold, crypto, and indices. And if I'm honest, most of that time wasn't spent getting better. It was spent unlearning bad habits I built in my first 2 to 3 years. The traders who shorten that curve are the ones who get honest about their mistakes early, instead of dressing them up as part of the journey for years on end. So this video isn't a highlight reel. It's the opposite. The mistakes that cost me time, money, and confidence. If you're early in your trading journey, I want you to see yourself in at least one of these, because that recognition is the fastest shortcut you'll get. Let's get into it.
The first one, and honestly the most expensive in terms of time, was strategy hopping. It started with indicators. I wasn't just using a few. At one point, I had over 2,000 MT4 indicators sitting in my folder. Moving averages, oscillators, custom arrows, non-repainting signal generators. You name it, I had it. And here's the thing about that phase. It wasn't laziness. It felt like research. Every time an indicator strategy lost 3 trades in a row, I told myself the indicator was flawed, not the way I was using it. So I'd go looking for the next one, a better MACD setting, a secret support and resistance indicator, something with an arrow that just told me buy or sell, so I didn't have to think. I spent 2 to 3 years like this, jumping from one indicator-based system to the next, never once staying with anything long enough to find out if the problem was the strategy or me.
Looking back, the real issue wasn't the indicators themselves. It was that I was searching for certainty in a game that only deals in probability. No indicator was ever going to give me that because it doesn't exist. What actually changed things for me was when I stopped hunting for a holy grail system and started studying market structure and price action directly. Things like smart money concepts and fair value gaps. Not because they're magic, but because they gave me a consistent framework I could actually test, measure, and refine, instead of abandoning every time it hit a losing streak. If you're jumping between strategies right now, ask yourself honestly, have I given this enough trades, not days, trades, to know if it actually doesn't work? Most of the time, the answer is no.
Second mistake, overtrading. And this one nearly wrecked my account more than once. I was trading lower time frames back then, mostly 5-minute charts, and I developed a habit of opening positions right at the start of the Asian session, when spreads are at their widest point in the entire trading day. I didn't understand yet why that mattered. I just saw a setup, got excited, and clicked buy or sell. What I didn't realize was that I was paying a premium just to get into the trade. Wider spreads meant my stop loss was effectively closer than I thought, and my take profit target was further away than it looked on the chart. I was fighting the spread before the market even had a chance to move in my favor. But overtrading wasn't just about session timing. It was also about frequency. I'd take a loss, and instead of stepping back, I'd immediately look for the next setup to win it back.
1 trade turned into 5. 5 turned into a full day of clicking buttons out of frustration instead of following any actual plan. On a low-frequency, high-filter strategy, the kind I use now, that kind of behavior is a system killer because the whole edge depends on being selective. The fix wasn't complicated. It just required discipline. Know your session characteristics. Know when liquidity and volume actually support your strategy, and accept that not trading is a position too. Some of the best trading days I've had were the ones where I did nothing at all. Third, and this one's uncomfortable to admit, I traded for a long time without any real risk management framework. I didn't have a fixed percentage I risked per trade. Some days I'd risk 1%. Other days, after a loss, I'd risk 5% to make it back faster. I didn't calculate position size properly. I'd eyeball my lot size based on how confident I felt, not on where my stop loss actually was. That's backwards. Position size should be a function of your stop distance and your account size, never a function of your emotions.
This is one of those mistakes that doesn't punish you immediately. It punishes you eventually, all at once, on the one trade where everything goes wrong. Fourth mistake, moving my stop loss further away when a trade went against me. This one is almost universal among beginners. You place a stop loss based on your analysis. Price moves toward it. Instead of accepting the trade was wrong, you move the stop loss back, giving the trade more room to breathe. Except it's not breathing room. It's just delaying the loss and making it bigger. I did this more times than I'd like to admit, and every single time it turned a small planned loss into a large unplanned one. A stop loss only works as risk management if you respect it as final the moment you place it.
Fifth, entering trades right before or during high-impact news releases without any plan for the volatility is just gambling with extra steps. Early on, I didn't understand how much releases like CPI or non-farm payrolls could distort price in seconds. I'd have a position open, news would hit, and the market would spike straight through my stop loss and beyond, sometimes with slippage that made the loss worse than it should have been. It took me a while to build the discipline of stepping back before major releases. Not because news trading is impossible, but because trading through it without a specific plan for that volatility is just gambling with extra steps. Sixth, revenge trading, which is really just overtrading's more emotional cousin. A loss doesn't just cost you money, it costs you clarity. And in that state, I'd convince myself I saw a setup that genuinely wasn't there, purely because I wanted to get my money back immediately.
Every time I did this, I lost more than the original trade. The market doesn't know or care that you're trying to win back anything. It only reacts to price. And last, for years, I didn't journal a single trade. I couldn't tell you my win rate. I couldn't tell you which setups actually worked and which ones I just felt good about. Without a journal, you're not really trading with data. You're trading on vibes and selective memory, where you remember the wins vividly and conveniently forget the losses. The moment I started tracking every trade, entry reason, outcome, what I felt, what I'd do differently, is the moment I actually started improving, instead of just repeating the same year over and over.
If there's one thread running through all of these mistakes, it's this. I was looking for shortcuts around the two things that actually build a trader: time and discipline. There is no indicator, no time frame, no strategy that replaces those two things. If you're in the middle of making some of these same mistakes right now, that's not a sign you should quit. It's a sign you're exactly where every trader who made it through has been. The only real mistake is staying there too long. If this resonated with you, let me know in the comments which one of these hit closest to home. I genuinely like to know I'm not the only one who had 2,000 indicators at one point. See you in the next one.